Welcome to The Rubber Meets the Road Economics, the podcast where we explore the driving forces behind today's economy and their real-world implications. Join investor Hunter Craig as he interviews Professor Edwin Burton from the University of Virginia, delving into the complexities of economics with clarity and insight. Whether you're an economics enthusiast or just curious about how economic policies affect your daily life, you're in the right place. Let's get started.
Professor, welcome. Today is December 19th, 2024. Danger, danger, Will Robinson, to quote the famous TV show. Yesterday we had something happen, hasn't happened in 50 years. 10 consecutive days of decline in the Dow. Yesterday, the Federal Reserve lowered the federal funds target rate by 25 basis points, but maybe more importantly, they lowered the reverse repo rate and came out and stated that emphatically. Can you speak to the relationship of Treasury yields, specifically the 1, 2, and 3-month Treasury yields, repo, reverse repo rates, and the federal funds rate? How are they related, and why are they going lower when the longer-term rates, the yield on the 10-year, is up 80 basis points while the yield on the Treasuries has declined roughly 100 basis points?
A lot of questions hiding in there, Hunter. The answer to all of those questions is pretty easy conceptually, but complicated in detail. But the answer to the first part of your question is that if you have two assets that are almost the same, then they should be priced about the same. You shouldn't have two things that are really essentially the same, and yet one has a wildly different price than another. And that's what comes to determine what goes on in the very short market. When you ask yourself, why is the Fed moving and things like that, what's happening is Treasury bills had already fallen in yield. They had dropped from the 460, 470 range down into 430, well below the Fed's target for Fed funds and its nearby partner, the repo market, or what is sometimes known as SOFR, the secured overnight funding rate. So what's going on there? Well, when we think about the Treasury bill market, often we say, well, there are 1-month, 2-month, 3-month Treasury bills, and we think that's kind of all there is. But that's not true. Treasury bills are auctioned every single week. So in any given week, there are Treasury bills that were auctioned 12 weeks ago that are coming due. So there are 1-week Treasuries out there. And if those 1-week Treasuries are yielding, let's say, 4.3%, then you can be sure the next auction Treasuries will try to come at the same number, 4.3%, or very close to it. So if repos are trading at 460, somebody with cash to spend are not going to buy Treasuries. They're going to put the money in repos because those are very similar in credit quality and very similar in maturity. One is 1 day and the other is 1 week. But you don't see big gaps in yields between 1-day Treasury-backed securities and 6-day Treasury-backed securities. So what's happened is the Treasury bill yields have already come down, and unless they bring down the equivalent securities in yield, dotted up people will buy the Monday's auction. And it doesn't have to be everybody. As you know, economics works at the margin. If 5% of the buyers decide to put money in the overnight repo market and not buy Treasury bills, the bill auction could easily get in big, big trouble. You need every buyer you can get when you're auctioning bills, and they're auctioned every Monday. Treasury bill market functions every Monday as long as Monday is not a holiday. So all of this is to say that if the Federal Reserve doesn't bring the target range down to compete with that 430 yield on the Treasury market, it'll hurt the Treasury auctions, and Jay Powell knows that. Which is why when he was in his press conference, I don't know if you noticed yesterday, but he kept referring to the new funds rate as 4.3. Now, that was interesting because they really target a range, not a specific yield. But 5 different times he said 4.3. Now, what did he mean by that? Well, I think 4.3 was on his mind. That was the target. That's where Treasuries were. So he was trying to bring that and the reverse repo rate down to the 4.3 neighborhood so that all these securities, which are essentially very similar, would have the same yield. And that's the underlying principle of why the Fed really doesn't control the overnight rate, because what happens is the Treasury market's a very competitive market, a huge number of buyers and sellers. There new ones are auctioned every week. And if the Treasury bill market, for example, if it were to go to 470 between now and January, guess what? They would take the target range right back up to where it was before this week. If it goes down below 425, they'll follow it right down with taking the target range to 4 to 4.25. So the Wizard of Oz is not the one controlling interest rates. The market controls interest rates. If you want to know why the price of something is what it is, it might be useful to consult supply and demand. Now let's get to your second question. Your second question is why, when the Fed, quote, lowers the target range, and now we know why they did that, why did all the other rates go up? Why is the short-term treasuries, why are they in great demand, forcing their yield lower and lower? But the 10-year and the 30-year are escalating. The 10-year is now 90 basis points higher than it was just 7 weeks ago. By the way, if you looked at mortgage rates today, they're back up in the 715, 730 area. So why are all those rates going up while the shortest rates are going down? Well, it's a flight to quality. It's a classical flight to quality. People are scared to death that rates are going to go up higher. And if you own the 10-year and the 30-year or a mortgage-backed security or whatever, that's not good for you. Whereas if you own the 3-month Treasury bill, you're not really at any risk. So let's load up on the 3-month Treasury bill, forcing its yields down, and let's get out of the 10-year and the 30-year. And that's kind of what's happening. There's a flight to quality in the bond market. People are fleeing duration. Duration is essentially a measure of the risk from holding a longer-term security. That's what duration is. There's almost no duration in short-term treasuries. So if you want real safety, you say goodbye to the 10-year, you say goodbye to the 30-year, and hello to the 3-month bill. Now, as long as there's this flight to quality, that's going to force the bills lower if it keeps going. And so you could see the bill yields. I'm not predicting this, but there's nothing would surprise me here. They're currently around 430. If they drop to 420, the Fed will take action in January. People are saying, oh, no, they're not going to do anything in January. Well, it just depends on what the bills do. Now, if you look at the Fed balance sheet, if they were actually controlling these rates themselves, there'd be some activity by the Fed. But there is none. You can look at the balance sheet. They're not doing anything.
But they can't control rates by the balance sheet.
No, they could if they wanted to. Sure, you could enter the market and buy $4 trillion worth of treasuries. And guess what? If they did that, the yields would fall quickly. Buy a whole lot of 10-years. If they want the 10-year yield to go down 100 basis points, then enter the market and probably take about $7 trillion to buy, but that would increase the money supply pretty quickly by 30%. So you get a lot of inflation out of that. But yes, the Fed has the power. The one power they have is to control the supply of money. They do not have the ability to affect rates except indirectly. Now, they can come into the market if they choose and do a lot, but they've never really done that. They've never really bought that much on a given day. Now, they've bought that much over a time period, but on a given day, they did one time. In 2020, they had a failed auction and they had to enter and buy $1 trillion worth of treasuries to support the auction. That did not make the news at the time. But it is the source. Take a look at Darrell Duffy's article at Jackson Hole 2 years ago, and you'll see a fairly detailed description of that. Just go to the Kansas City website, Jackson Hole Symposium, and look for an article by Darrell Duffy at that symposium. It's available online. And Darrell Duffy is probably the leading financial economist in the world, and he teaches at Stanford currently. And he laid out all the details of that $1 trillion episode, but that's kind of it. Usually the Fed balance sheet doesn't do much of anything. Why should it? They're just following other markets. They don't have to do anything. They just have to lower the target range, and lo and behold, it solves their problem. And that's what they did yesterday. And of course, yesterday, if you listen to the press conference, Powell always holds a press conference, as does every Fed chairman after an interest rate decision. They ask him a natural question. Imagine you were taking Economics 101 at Harvard or anywhere, and they ask you on an exam, we want to ask you about how Fed policy works. And here are the circumstances. Inflation has been ticking up, and the economy is on a growth spurt. It's estimated the economy will grow at 3% this quarter. Last year, it grew at 2.5%. So you got the economy getting stronger, inflation getting higher. So what is Fed policy? Well, let's try lowering interest rates. If you put that on an exam, you'd get a 0. That's not what they teach you. They teach you that Fed lowers interest rates when the economy is falling apart, when inflation is under control, not when the inflation is taking off again and the economy is booming. So why did they do it? Why did they lower rates? And it was interesting watching the press conference yesterday. because that was really what people were asking over and over again. Different phrases, different ways of saying the same thing, but they kept saying, Chairman Powell, inflation's picking up. Why are you lowering interest rates? Well, the answer to the question is he didn't have any choice. The yields were already at the 430 area in the T-bill market, and he had to lower all the other yields to get them in sync with 430. He can't say that because that's like saying, hello, world, I have no power. I'd just like you to know that the Fed doesn't have a damn thing to do with interest rates. The day's not going to come when any Fed chairman says that, so you can forget about that. So they come up with all these other things. And what does Powell talk about? Well, if you were asking the question, why has the price of apples gone up? Here's how you would answer it if you were Jay Powell. You'd say, well, the price of apples went up because the demand for paper bags fell pretty dramatically. And you might say, what does the demand for paper bags have to do with the price of apples? Well, you could ask Powell, same question. Yesterday, he talked all about the labor market. Yeah, labor markets, it's getting a little looser. Unemployment is about here and there. What in the world's the labor market got to do with the rate of inflation? Well, it might surprise you. That's what people think causes the rate of inflation. Very low unemployment. And yet, we've had very low unemployment with no inflation, and we've had very low unemployment with a lot of inflation. We've had a lot of unemployment with low inflation and a lot of unemployment with very little inflation or very much inflation. There's no connection between the level of unemployment and inflation. And there's none now. There's just none at all. But that's what they talk about because they don't want to talk about, if you want to know why the price of apples change, why not consult supply and demand for apples? That's what we teach in the other micro course. And the same thing applies to money. If you want to know why the value of money is changing, why not look at the supply and demand for money? That's the only issue that really matters. And the Fed controls that money supply. They control it. The Fed is the only entity in the world that can produce dollars at will. And it doesn't matter what Congress thinks. It doesn't matter what the White House thinks. They have a unilateral ability to do that without consulting anyone. No one. It's a ridiculous power to give them, by the way. I think a lot of politicians who've called for the elimination of the independence of the Fed are correct. There is no reason to have an independent agency that can print $7.5 trillion without any authority from the Congress or the White House. And that's exactly what they did. They did that from 2020 to the end of 2021. They shouldn't be permitted to do that. They caused the inflation by doing that. Now, they may have had all the great motives and they may all be smart people, but it didn't work out too well for the country, and they shouldn't have that kind of authority.
The U.S. federal deficit this year, 2024, will be a record in the history of the United States, peacetime, non-COVID, just shy of $2 trillion. There is a flight to quality, at least partially due to investors' fear of interest rates rising, which would mean their bond portfolios would suffer a serious reduction in value. Can you speak to the U.S. deficit, and can we solve this deficit without dealing with two items? One, healthcare, and two, Social Security.
Well, the national debt is a huge problem. Before I answer that question fully, many people have said the national debt's not a problem, including the incoming President, Trump. And I've talked with one of his key advisors, a close friend of mine, Stephen Moore, and we've discussed that actually in an open forum. And Steve said in an open forum as recently as 3 months ago, this is really not a problem. The national debt's not a problem because our national wealth is so high. Well, people don't get in trouble because their debt is not higher than their wealth. Your wealth can be much higher than your debt, but you can run out of liquidity. That's what causes bankruptcy. It's not that these companies don't have any wealth. They've got a huge store of wealth. They've got trucks and plants and everything else. They just can't pay their bills, and they can't pay the interest on their debt. And the U.S. is in the same position. Yeah, we got a lot of wealth. We're going to sell all the national parks to pay the interest on the debt next year, or sell the Pentagon, or how do you go about using all this so-called wealth the government has to deal with this? The main source of dealing with the debt is income taxes that you can collect from companies and individuals and other forms of taxation and other forms of revenue. But the level of your wealth is, at least in the short run, irrelevant. What's relevant is what happens at these auctions every week. What happens on Monday morning when they go to the market and try to sell T-bills? If those T-bill yields go from 4 to 7, we're in big trouble because 3% extra on 36 trillion is a big number. So it is a big issue, the size of the debt. And these debt levels that we're looking at, not only in the U.S., but across Europe and across the globe, are record-setting levels. Everyone is beginning to look like Greece looked a decade ago. And cities and states are no better off. Cities and states blinded themselves to their problem because they got these huge COVID handouts in 20 and 21. And now those handouts have gone away, and every major metropolitan area and state that had those handouts is now looking for billions and billions of dollars to make ends meet. Chicago being maybe the most notorious case, but California's in the same shape, and pretty soon even states like Virginia will feel it. So debt is a problem literally everywhere. And it's even a problem in the private sector. There's an enormous amount of private debt. The CMBS market, which you're probably familiar with, Hunter, which is a key financer for commercial real estate, that market issuance is up 160% this year compared to last year. It's just record-setting numbers. So debt is everywhere. And if you ask why are rates so high, debt. If everybody wants to borrow and nobody really wants to save and invest, rates are going to go up. The price gets very expensive. So it's a big problem. So how do you face it? Well, if you look at the spending side of the national government, it's dominated really by two things. Expenditures that, broadly speaking, are about health care, that is Medicaid, Medicare, and other government subsidies in the healthcare arena. And secondly, Social Security, which as these are not things that are going to be easily dealt with, but if you don't deal with them, you can't solve this problem. Nothing else, really. You can get rid of the education department. You can even get rid of the Pentagon. It's not going to make any difference. You have to tackle the entitlements. That's the only way. And so how do you do that? Social Security to me is easy. And the reason it's easy is that a lot of the benefits go to people who are over the age of 80 or over the age of 75, if you like. And those tend to be the richest demographic in the country. Poor people do not live to be the same age as rich people. And so you can tax a lot of the Social Security that you see keeping people alive after age 75. People don't want to see that, and they say, oh, that's not fair, I paid in. But if you're going to solve Social Security, you're going to do things you don't like, and I think it'd be better maybe tackling people who really don't need Social Security. I count myself among them. Warren Buffett would probably give up his Social Security. I would give up my Social Security if you want to tax it all away, if we can solve that problem. And I bet you would too if you were my age. I think most people who have means would be happy to walk away from their Social Security benefits, but only if a solution to this problem were put forward. And I think there's an obvious solution. You begin to transfer some of the contributions over toward IRA-type structures, but you quit letting people use special reasons to withdraw. No more exemptions for withdrawing for a new home or for emergencies. Just force them to stay in. You don't let them withdraw Social Security payments. Why would you let them withdraw IRA payments? Leave it in there. Make them put roughly 80% in index stocks if you like. It's true, I don't like forcing people to do anything, but we're already forcing people to do something. We're forcing them to pay into a system that doesn't pay them back what they get. I mean, look at the numbers. The average family income in Virginia is $80,000 a year. You pay 6.5 as an employee, and your employer pays another 6.5. 13% times 8, what that number is, that's $10,400 a year. If you had that in an index fund from age 21 to 65, remember the numbers? You'd have $16 million. That sounds like a pretty good deal, but you're not going to get $16 million by the time you reach 62 or 65 or even 69. Because Social Security is a bad investment. So it's not good for employees. It's not good for recipients. And worse, when you die, it dies with you. Your spouse might collect, but your children won't.
So if you were the benevolent dictator, how would you solve healthcare?
Well, I think healthcare, like any other area where you have a scarce resource, a lot of demand for it, I think the free market has to be the primary method of allocating healthcare. And if people want to pay for it, let's take the end-of-life discussion. I think we had a little of that before. Most healthcare expenditures, the majority, are in the last 2 or 3 years of someone's life. So if I come to you, Hunter, and I say, Hunter, I can keep you alive for the next 3 years. Give me $5 million and we'll pull that off. I doubt that you would do that. I know I wouldn't do that because I've got grandchildren that would like to spend that $5 million themselves. And if I'm in that kind of shape where I've only got 3 years to go, what kind of quality of life am I going to be propped up with? People should make that decision on their own. But now you don't have to make it, right? You can spend everybody else's $5 million. You can spend $5 million that other families need to take care of their own families and their own children. You could spend that money propping yourself up for 3 years. That happens every day of the week. There are people all over this country who can't speak, can't communicate, can't get out of bed, and yet the cost of keeping them going is millions and millions of dollars. It may sound cruel to say we shouldn't be spending it that way, but everything's a choice. There's a 5-year-old kid out there somewhere who needs that and needs the help and needs health considerations, and you can make a difference in his life, and yet you're propping somebody up where you can't make a difference in their life. You're just letting them breathe another month or two. We have to face the facts that we cannot keep spending healthcare dollars like this. If somebody wants to do that, fine. If Warren Buffett wants to shell out $20 million to live another year, I'm all for it. I think that's great. But we have this strange view that if he wants to do that, then everybody should have the same right. That's kind of ridiculous. We don't have the money for everybody to spend $20 million on everybody to give them an extra year in life.
Would a good start be able to buy catastrophic? Right now, you're prohibited by law from buying catastrophic health insurance. Would that be a good start?
Yes. It's weird how the insurance works in healthcare. For example, if you look at your insurance policies, what does it pay for? Well, consistently, it'll pay for predictable expenditures. For example, in dental care, it'll pay for dental checkups. But if you have a root canal, no, it won't pay for that. But that's when you need the help. You don't need the help paying for the dental checkup. It's almost like they're insuring your grocery bill. Okay, you've got your grocery bill. Let's go insure it. But if we insured everybody's grocery bill in America, which we could do, there's no reason we can't do that if we can provide Obamacare and Medicare and Medicaid, what would happen to grocery prices? And how efficient would shoppers be? If somebody else is paying all your bills, you might go in there and say, well, I came in here, I really only wanted 2 apples, but what the heck? I think I'll take 80 apples because we're thinking of having an apple fight in the backyard. Apples are not only for eating, they're pretty good for throwing at one another. I mean, you could think of all kinds of great reasons to take stuff out of the store. Who knows what you do? But if you go into a grocery store, that's not what you see. You see the lady calculating exactly what she's going to spend, trying to choose, do I want this product or the cheaper one? That's what we need in healthcare. And I know people think everybody has a right to healthcare, but we can't afford to have everybody has a right to whatever they want in healthcare. That just doesn't work. We're going to bankrupt the country looking at that point of view. The vast bulk of healthcare, people, for example, should pay all of the predictable expenditures themselves. Insurance is for things that are unpredictable, that are unforeseen, and now all of a sudden, wham, I got whopped. Now, the complaint about this would be, well, what about poor people? Well, there's plenty of opportunity to help poor people. There are plenty of people that are poor that need health care that we can provide, but you can't provide it for everybody in the middle class. You can't offer, $50,000 per family of free health care. Society doesn't have those kind of resources. There's only a very small percentage of America in poverty, in actual poverty. The number is below 10% of the country. This is the richest country in the world, after all. So that wouldn't be a big problem, and it wouldn't be a big problem to deal with people that have pre-existing conditions at birth. If somebody is born with some kind of birth defect, why, by all means, the government can certainly deal with that. But that's not what we're doing. You wouldn't have much cost in healthcare if you focused on those issues, helping poor people and working with pre-existing conditions, because the dollar cost of that is minuscule. That's not what's driving the healthcare budget in this country. What's driving the healthcare budget in this country is people overusing the healthcare system, typically not shopping around, just, hey, my insurance company's going to pay for it. Yeah, I'll do this, I'll do that. The rush to the emergency room, which, by the way, only really works for rich people. I don't know if you've been to an emergency room, but poor people go into the emergency room, they sit there for 11 and 12 hours. 10% of them just leave eventually. So the current system is not very friendly to poor people, and they can tell you that. But insurance costs are, a reminder of that is a terrible tragedy in New York where people start blaming insurance companies and things like that. That's not who is at fault. Insurance companies are not at fault, and that insurance guy, it's not his fault either. They're trying to make a living. They should be permitted to sell insurance the way they want to. not the way the government tells them. They don't have that choice now. What we have is a government program. We don't have a private health insurance program. What we need is a private health insurance program. So I think if you did that, you'd make healthcare a lot more efficient. And I think you could tackle the budget if you went that route. And a good source on that, if you want to, I'll plug my good friend John Goodman. He wrote a book called Priceless. I get nothing from this. John doesn't send me a percentage. But that details the problems of the American healthcare system and suggests some of the same solutions that I've suggested here. So people really want to know about it, read that book.
Thank you for the reference to the Priceless book. We will put the link in the show notes of the podcast. Today, getting close to the end of December 2024, what's your prediction? Dow, 12/31/2025, higher or lower?
Wow. I think I told somebody the other day when I was making a forecast, my forecast, here's how valuable they are. My forecasts are as good as flipping a coin. If you flip a coin, you got half a chance of being right and half a chance of being wrong. That's my chances on making a prediction. Nevertheless, I'll make a fearless prediction. But don't run out and buy or sell based on what I say. And I feel the same way about interest rate predictions, by the way. I seem to talk like I know what interest rates are doing, but in the short run, I have no idea. I couldn't tell you whether the 10-year is going to be 5.5 or 3.5 6 months from now. I just don't know. But once it happens, I can explain it. And if we get close to a date, I can predict it.
But long term, you think rates are going higher?
I think rates are going higher. I don't think they're going to solve the debt problem. I don't think there's a political will to deal with it. I think the economy could be in trouble. I see caution lights here. I think no one else thinks so. I watch CNBC and everybody's very optimistic. I'm not as optimistic. And I think the same about the stock market. I think the stock market could be in trouble. I don't know about between here and the end of the year, but I would say over the next 6 to 8 to 10 months, I think the stock market could be in trouble. We could be seeing higher interest rates, and I think the economy will be in trouble. Let me just add a footnote to the economy because we haven't talked much about the general economy. So why is it I would think it's not likely to do well? I think a lot of it has to do with two things. One is we've spent an enormous amount of our treasure in things that are going bankrupt. We've done that over the last 3 or 4 years, and now we have a president coming in whose main agenda is to slow down international trade, which I think will hurt us. And so I think the two political parties have almost conspired to get us in trouble here as we enter the next year. So I would hope that we would get back to free market policies, and when we want to do something like climate change, we use free market type solutions. What we're doing now is, Hunter, you're my friend here, take $20 billion and see if you can figure out how to make batteries. That's the policy. It would be much better if we just provided an incentive, like a carbon tax or something like that, and made it more expensive to use fossil fuels or something like that, and then let the market decide how to build batteries and do various things. But we chose not to go that way. And we've spent literally trillions of dollars, and much of it's wasted. You can't pick up the Wall Street Journal without seeing another bankruptcy in either the battery world or the EV world. And that's going to continue. And those are lost resources. And I think that's going to be a problem. So not mildly, I am pessimistic on the economy as we go into next year. And I'm pessimistic on the stock market and the situation in the debt market.
Professor, thank you. You're the best of the best. Thank you, Professor.
Thank you for joining us for the Rubber Meets the Road Economics podcast. If you enjoyed the discussion, remember to subscribe and stay updated with future episodes. Join us soon for more conversations about modern economics on the Rubber Meets the Road Economics podcast.